Title on screen, Merchandising. Company Accounting. Understanding the basics and applications. Introduction. Narrator. Welcome to our accounting tutorial. In this session, we will explore merchandising company accounting, essential for understanding how transactions in such companies are recorded and reported. Slide 1, Definition of a merchandising company. Narrator. A merchandising company is a business entity whose primary activity is purchasing goods for resale without altering their form or nature. Examples include grocery stores, supermarkets, and electronics distributors. Slide 2, Characteristics of a merchandising company. Narrator. Key characteristics of merchandising companies include 1. Main activity, purchasing and selling merchandise, without production processes. 2. Revenue source, profit, is derived from the difference between the selling price and the purchase. Cost of goods. 3. Inventory, maintaining merchandise inventory accounts, recorded on the balance sheet. 4. Operating cycle, involves purchasing, storing, and selling goods to consumers. Slide 3, Types of merchandising companies. Narrator. Merchandising companies can be classified based on the products they trade and their customer types. 1. Based on products. Production goods, selling raw materials or production equipment. Finished goods, selling ready-to-use products. 2. Based on customers. Wholesalers purchasing products in bulk from manufacturers and reselling to retailers. Retailers, selling products directly to end consumers in smaller quantities. Slide 4, Accounting cycle of a merchandising company. Narrator. The accounting cycle of a merchandising company includes several stages. 1. Recording transactions, documenting all purchase and sales. Transactions in the general journal. 2. Posting to the ledger, transferring data from the general journal to ledger, accounts to categorize similar transactions. 3. Trial balance, preparing a trial balance to ensure the equality of total debits and credits. 4. Adjusting entries, making adjustments to certain accounts to reflect the actual condition at the end of the period. 5. Financial statements, compiling the income statement, balance sheet, and cash flow statement based on adjusted data. Slide 5, Example of transactions and recording. Narrator. Here is an example of recording transactions in a merchandising company using the perpetual system. Purchase of merchandise. Date 1. Purchased merchandise worth $5,000 in cash. Journal entry. Debit inventory $5,000. Credit. Cash $5,000. Sale of merchandise. Date 3. Sold goods worth $2,000. COGS $4,500. Journal entries. Debit. Cash $2,000. Credit. Sales $2,000. Debit. Cost of goods sold $2,500. Credit inventory $2,500. Slide 6. Financial statements of a merchandising company. Narrator. The primary financial statements prepared by merchandising companies include 1. Income statement, calculating net income from sales minus COGS and expenses. Simple format example. Sales, $10,000. COGS, $6,000. Gross profit, $4,000. Operating expenses, $2,000. Net income, $2,000. 2. Balance sheet, showing the company's financial position, including assets, liabilities, and equity. 3. Cash flow statement, presenting cash inflows and outflows over a specific period. Conclusion. Narrator. This concludes our brief overview of merchandising company accounting. Understanding these concepts and processes will help you apply this knowledge in daily accounting practices. Thank you for watching, and see you in the next tutorial.